All right, today we're putting a company under the microscope that is, let's be honest, a part of daily life for millions of people, Starbucks. But here's the big question. Does having an amazing brand automatically make it a great investment? Well, we're going to find out.
I mean, you know that green logo. Everybody does. It screams consistency, right? Doesn't matter if you're in your hometown or halfway across the world, you know exactly what you're going to get.
But does the financial health of the company actually match up to that brand strength? We're diving into a really interesting analysis from Save Invest Compound today, and well, it suggests there might be a pretty big disconnect. Okay, let's get into it.
So here's how we're going to break it down. Think of it like a financial checkup. First, what is the business? Then we'll check its vitals, the financials. We'll look at the good versus the bad, figure out what a fair price might be, and finally deliver the verdict.
All right, first things first. What is the engine that's actually making Starbucks tick?
Okay, so this is where it gets really interesting. The analysis points out something crucial. Starbucks isn't just selling coffee. They're selling a habit. They call it a consumer habit engine, which is a great way to put it. They're cashing in on our daily routines by making it super convenient, leveraging that powerful brand, and locking us in with their digital rewards and loyalty stuff. It's genius, really.
Okay, so the business model is all about habit, but you can have a great-looking car with a powerful engine that's, well, leaking oil everywhere. So are the financials healthy? Let's pop the hood and check the vitals.
And wow, this slide right here, it perfectly lays out the big problem. You've got the perception, right? Strong brand, unstoppable revenue. But then there's the reality, and the numbers are telling a totally different story. We're talking negative cash flow, a mountain of debt, and profits that are actually shrinking.
Let's start with a huge red flag. Levered free cash flow? It's negative. So what does that mean? Basically, after all the bills are paid, including debt payments, the company is actually burning through more cash than it's bringing in from its main business. That is not a good sign. It's a pretty serious problem.
Next up, the debt. And we're not talking a small amount here. We're talking about over $25 billion sitting on the balance sheet. That's a massive weight, and it becomes even riskier when you remember that cash flow we just talked about, the one that's negative.
And then there's this, the dividend. The company is paying out more than 200% of what it earns. Let that sink in for a second. For every dollar they make, they're paying out $2. How is that possible? Well, the analysis says it's totally unsustainable unless they keep borrowing money. So yeah, the numbers are screaming a very, very different story than that friendly logo on the cup.
So you've got the good and you've got the bad. How does it all stack up? Let's take a look at the analyst's SWOT framework to see how these strengths and stresses balance out.
I really like how this is laid out, because it puts numbers to everything. Look at brand strength, a 9 out of 10. No surprise there, right? Global scale, the digital stuff, also scoring really high. But then you get to the financial side. Margin pressure gets a measly 4, and that negative free cash flow, a 3. It's so clear how these incredible business strengths are just getting dragged down by some really weak financial foundations.
Okay, so with all these financial problems, what's a fair price for the stock? What is this company actually worth? So the analysis gives us 3 possible outcomes. In a bad bear scenario, the stock's worth maybe $65. In a super optimistic bull case, it hits $100. But the most realistic base case, that pegs the real value at around $80 a share. And you got to remember, the stock has been trading closer to $97. That is a huge difference.
And for anyone thinking about this as a long-term investment, this table is everything. Let's say you want to make a pretty standard 9% return per year. Look at the prices you'd need to get in it. Even if you're willing to wait 16 years, you'd have to buy the stock at $70. That's nowhere near where it is today.
And these scores just sum it all up, don't they? The risk is sky high, an 8.1 out of 10, thanks to all those financial issues. And the opportunity for a good return? It's mediocre at best, a 5.5. Not exactly a glowing review.
So, we've looked at the business, the financials, the valuation. We've weighed all the evidence. What's the final call? What's the diagnosis?
This quote from the analysis just hits the nail on the head. The market is pricing brand strength but ignoring profitability decline. What that really means is people are paying up for the Starbucks they think they know, the powerful brand, but they're completely ignoring the fact that the actual business underneath is getting weaker. And so the final verdict couldn't be more clear. It's a big, fat avoid. The combination of weakening financials and a sky-high price just makes it a no-go, according to this analysis. So let's just run through the key points one last time. You've got this amazing brand, but it's hiding some really ugly financials. That negative free cash flow is a massive red flag that you just can't ignore. And at the end of the day, the price is just too high for the amount of risk you're taking on. The analysis says a much safer bet would be somewhere down in that $65 to $70 range.
So there you have it. That's the full breakdown on Starbucks. What do you think? Do you agree with this analysis, or are you seeing something different? And more importantly, which company should we tear down next? Drop a comment below and let us know. Thanks for tuning in.